Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It's Tuesday, May 8th, 2018. Hope you had a nice weekend. We did something that I can't think my wife and I have allowed our children to do since they were born. And I think I told you we're watching The Blacklist. And I started it off thanks to the reader, John, who had mentioned that it's something to watch. And now I'm hooked. And we're binge watching. I mentioned that last week. I'm going to mention it again. So my wife then started watching it about a week after I did. And then my daughter and son started watching it. And we're all at different points. Now, this is not good for family time, I have to tell you. Luckily, we get enough family time elsewhere. But we're all hooked. Sunday, my wife and daughter went into Manhattan and they saw a play, and my son had a lacrosse game, and he and I were hanging out for a while. And then they got back for dinner. And what did we do? We all were away from the house for the day, and we all couldn't wait to watch Blacklist. But now here, all four of us are on different episodes. So it was one of the most ridiculous scenes at our dinner table. Now, normally Sunday night is just no matter what we're doing, we're all going to get together for dinner, and we're going to have dinner, and we're going to talk about our week and how what's coming up, and we get our game plan together, and everything's good. And sometimes some of our neighbors are over, and our kids' friends know if they come over on Sunday night, if they have dinner with us, they have to tell us about what's going on for their week, and that's what it is. Not this Sunday night. So what happens last night? We're all four on our iPads with our earbuds in, watching our different episodes. I mean, it was ridiculous. If you looked at the scene and you just were looking at it if you were peering through our windows, you would say, oh my God, look at this family. They're dysfunctional. No, we're not dysfunctional. I mean, some days we are like anyone else, but we're all hooked on this, and we're all, and for me, now I'm the leader, right? Because I'm ahead in the watching. So everyone's asking me what happened, and I'm not giving it up. Now, my wife, the way she's a voracious reader, but she reads, I don't know if you remember When Harry Met Sally, the movie When Harry Met Sally, and he would go to the end of the book and read it and then start it. That's how he did. My wife does that. So we often joke the movie When Harry Met Sally. If you don't know it, it's about two friends who got to know each other, and then they after a lot of time they wound up being together. Well, that was my wife and I. We were friends for a long time. And in the movie, Sally orders. She's a real pain in the neck when she orders her food, to where people just look and notice and say, "Oh my God!" Well, that's my wife. And she also and Billy Crystal is the one who went to the back of the book. So my wife does both. She likes when she orders, me and my kids just put our head down because it's got to be a certain way, and we're in a restaurant, and it's a joke, right? We all laugh about it, but she also likes to know the ending first. So here I am under a lot of pressure to tell everyone what's going to happen, but I'm not giving it up. And my kids are doing the same thing, so I'm holding tight. But again, Blacklist, I can't recommend it enough. I'm going to touch on baseball. My Mets have imploded. I think 3 weeks ago you would have heard me say how excited I was. Forget it. It's over. Feedback. I got some feedback. Some guy said, hey, look, stop with the personal stuff. You're not Frank. Frank does it better. Awesome. That's great. Like I said, there's a lot of other podcasts out there that you can listen to. This is my time to help educate you on my time, on my dime. And I hope you do all find it valuable. So if you're unhappy with the personal stories, I apologize for that. You could fast forward them. You don't have to listen to them. But I kind of enjoy sharing them. And by the way, the overwhelming feedback I get on them is they get a kick out of it. So anyway, let's move on to stock stuff. Earnings are in full swing as of now. Well, today's Monday, but 81% of the S&P have reported earnings. Equity, I mean, again, blowout earnings, blowout sales, fantastic. But the market finished mixed. S&P and the Dow lost about 20 basis points, or 0.2% every basis point. When you hear me say basis point, by the way, it's 1/100%. So the Dow and the S&P lost 20 basis points, or 0.2%, and the Nasdaq, which is pretty tech heavy, they had some good earnings, was up about 1.3. A lot of news on the for investors to digest last week. You saw the policy director from the Fed. You got the employment situation report for April, which was good. And like I said, corporate earnings were coming in full swing, and it's just one after the other, earnings call after earnings call after earnings call. But the Fed basically came out and they left rates intact. The Fed funds rate, they left it unchanged. Their target rate of 1.5 to 1.75%. But they did lay the groundwork for a rate hike at the June meeting, and they did leave the door open for another 1 to 2 hikes before the end of the year. During the week, there was a crazy conference call, the Tesla call. If you follow financial news, you might have heard of it. Obviously, it's a stock that just draws tremendous emotions on both sides, but from the bulls and the bears. Elon Musk is a lightning rod. Some people love him, some people hate him. The bulls will tell you that it's not a car company, it's a tech company, and the stock's had a tremendous run. And he's quite the entrepreneur. He's done a tremendous job, right? He started this thing from scratch, and look what he's built. And people think it is that those who think it's an automobile company get it wrong, that it's a tech company. I'll talk further at some other time about my views on Tesla and what I think. I don't want to get into a Tesla analysis right now, but I will talk about the conference call. And on the conference call, if you haven't listened to it or read the transcript, I suggest you do so. I've been listening to conference calls, earnings calls, and I've sat in with, thousands of CEO meetings, one-on-ones and group meetings and conference calls. And this is near the top of, you got to be kidding me. So Musk was very dismissive. Now, normally, and this is interesting because normally the way this works is the sell-side analysts are typically more promotional. They're more of the cheerleaders for the company. And you've heard me talk about this before, or if you haven't, when you look at the number of actual sells from the investment banks on a company, the number of sells might be 5, 6, 7%. When you see a hold on a stock, when the rating is a hold, that typically means, it might mean sell, it might mean not, but they're afraid to come out and say that because they don't want to damage the corporate banking relationships with people, with the companies. It's hard if a company is doing a merger and acquisition deal. It's hard to do if they're looking to raise equity or raise bonds. If your analyst at the investment bank is out with a negative rating, you're probably not going to see that business. But most of them are buys or strong buys. And typically on conference calls, normally they're the analysts, a lot of them give softball questions to the CEOs and CFOs and the rest of the management team. Or if they're not softball questions, they may be a little probing, but there's a protocol that they all typically follow. But the better management teams understand that. The good management teams understand that, hey, you're going to get some tough questions, you're going to get some softballs, and that's kind of how it works. But normally the sell-side analysts are not there to hammer the company on the conference call. You might see that if a company blows earnings and they were left holding but the analysts were caught off guard because management had been given body language or they were talking publicly about how good things were. Now the analyst has egg on his face. But in a case like this, it's interesting because the Tesla bulls, and led by Elon Musk, the CEO, he despises getting difficult questions about the company. And, obviously the bears will say the company's burning cash at a rapid rate, and it is, and they think they're going to need to raise equity this year, and I do as well. That leaves you open. If you're a public company and you're taking public shareholders' money and you're issuing debt or you've got equity out there, you've got to answer questions. And the format to do that is this conference call. Well, on the conference call, there were a couple of sell-side analysts who asked some questions, and they were basic questions. It was capital expenditures and cash and just stuff that you have to ask to be fiduciarily responsible. And Elon Musk cut the analyst off. Said it, and he said he's done with these boring questions, and he was dismissive, and he wouldn't answer them. And then he went to a YouTube a retail investor that asked about 20, 25 minutes worth of questions, which is great. Normally you don't get to see that. Normally companies don't do that, but they don't let retail investors on the call. But it's not at the expense of avoiding the questions from the analysts. It's one thing to avoid questions or to put a spin on the question, but to say that they're boring and they're mundane when you are a company that is bleeding cash, you are burning through cash like there's no tomorrow. You owe investors an explanation. Now, the bulls, I know you Tesla bulls are going to come out there and I'm going to get all sorts of nasty email. I don't care. I'm just telling you the way it happens. And thou that protest too loudly. The best CEOs I've seen, everyone has a short case on a company, but the best CEOs I've seen ignore it, because the best way to shut a short up is to say nothing but focus on your business, not to spend a lot of time on Twitter like Elon Musk does and come out and talk about he's going to burn the shorts. They're going to get run over. A short squeeze is coming. I can't think of anything more ridiculous. If I'm a Tesla shareholder and I'm stepping back and saying, wait a second, this guy hasn't met a production number in forever. Yeah, okay, he builds a nice car, and I know a couple of friends of mine have him, they love him. I'm not getting into that. Is he revolutionary? Maybe. But we're not going to get into that debate. But what I am going to get to is the way you conduct yourself on the call and what you owe shareholders and history. If history doesn't repeat, it often rhymes. And the fact that this guy is so obsessed with short sellers, when on this very same conference call, he says, if you're worried about the short-term movements in my stock, then you shouldn't own it. Well, if you can make that statement, then don't worry about what the shorts say. Because if you produce day after day after day and deliver on what the expectations are, the shorts will get run over. Because you'll do it. You'll produce. It's just, I can't recall seeing such an absurd conference call. Right. And at some other time, I'll get into my view on Tesla and the numbers and all that stuff. Am I bearish? Yes. Do I think they're a car company and not a tech company? Yes. Do I think they're going to have to come to the market to raise capital? Yes. But if I'm a bull, and I see like on Twitter, it's unbelievable the worship that there is for Elon Musk and the shameless promotion and the childish tweets that come from him, the thin skin that he has. Warren Buffett said something during the week, and it wasn't complimentary towards Tesla or Musk. And then at the Berkshire Hathaway meeting yesterday, he said something about having competitive moats, and Elon Musk wouldn't want to compete against us in the candy business. Right, because Berkshire Hathaway's owned See's Candy, one of the storied old candy brands. Well, shortly thereafter, Musk is out saying he's starting a candy company, and he's going after Buffett. It's just ridiculous. Run your company. You're a brilliant guy who started a company or had the vision to start a company. Maybe you're brilliant, maybe you're not, but you had the vision to start a company. You've created a vehicle that no one else was putting out there. And now you're starting to compete against a lot of people. Block and tackle. Block and tackle, and don't worry about promoting, and don't worry about trying to burn the shorts, because all you're doing is giving the shorts more conviction. And it's stunning to me. So anyway, that's my rant on Tesla. Okay, let's just get to the earnings. Like I said, 81% of the companies in the S&P have reported results. 78% of them are reporting earnings above estimates. That's good. It's above the 5-year average by quite a bit. And it's the best number, the 78%. If that holds for the other 19%, we see that of the S&P 500 companies, it's going to be the most number of companies since FactSet started tracking this back in the third quarter of 2008. So here we have 24% earnings growth in the first quarter. We have 8.5% sales growth. Excellent, right? Great news abound. And for the week, stocks finished mixed. As I said in the top, Dow and the S&P lost 0.2%, and the NASDAQ was up 1.3. So I'll continue what I keep saying, stay cautious. The market is telling us something, and this great earnings, I think, have been priced in, and I think bulls have to ask what's next. Turning to the interviews, I think if you've been listening to me for a while, and if you haven't, I'll share with you, I love investing in deep cyclicals, whether it's on the long or the short side. I think that it's a great opportunity to take advantage of where the narrative has been extrapolated too far into the future. And oftentimes that's where change is taking place, and especially in elongated cycles, bull or bear cycles. Oftentimes the industry experts and investors who know the space extremely well have been burnt, or they've been overjoyed, depending on what side that you're looking at. And oftentimes the bad times are extrapolated out too far, and as are the good times. So I have two guests on today that one is a CEO of a company and the other is someone who writes research about an industry, but both deeply cyclicals. My first guest, though, is the CEO of a uranium mining company, an African uranium mining company, and it's Daniel Major of Goviex. And like I said, Goviex is not only a company in industry, uranium, that's out of favor, but because of their locale, Africa, it's out of favor. During these risk-off periods, people don't want to own uranium miners, and they really don't want to own African uranium miners. But we're going to talk about that. So with that, Daniel Major, welcome to the podcast.
Hi, Mike. It's a pleasure to join you.
Great. So Daniel, I have to say, since you and I started talking probably over a year ago, we've seen a lot of the things that we were talking about in terms of catalysts needing to occur, starting to happen. So why don't you just let's talk about from Daniel Major's viewpoint, the state of the uranium industry. Where are we at right now?
Not where I wished it was be. But I think you and I have always talked about the big picture to start with. We've always said, the long-term demand is there. The supply is going to struggle to keep up, predominantly because of the unit cost of new entities trying to come on stream, and that we're going to have a supply gap. I think, unfortunately, what's been affecting the industry in general is that gap on inventory has just held tighter for longer than we're expected, and we have seen inventories gradually being squeezed in various parts of the market. I think we've seen the production cuts that we were forecasting, but they've not come as hard and as fast as we thought they would be because long-term contracts have held out. But I certainly think coming into 2018, we're starting to see some real green shoots out there and some real potential changes that I think are going to make the uranium market pick up in the second half of this year.
Daniel, it's interesting. One of the things that I find fascinating about the uranium market, and if we think about the market, it's opaque, it's complicated, and there's if you think about most commodities, you can go and find a futures contract, and it's heavily traded. Uranium has a futures contract, and it hardly doesn't trade at all. It's very few people can take physical delivery of uranium, but the market, everyone focuses on the spot market, and the spot market is very, very thinly traded and infrequently traded. And the major buyers, with the exception of the brokers who are trading for their own account, but it's really, when it moves, it's the utilities that come into the market that are really going to move it. And we talked about contract expirations. You saw heavy contracting taking place in 07, 08, 09, 10, even 11. You saw 150, 200 million pounds contracting at those periods. And those contracts are 7 to 10 years. And then you've had the carry trade, which you've seen some of the shorter, because low interest rates, you could get the banks or the brokers to really, if you're a utility, you get them to carry some uranium for you, and they had very low interest costs. And so you saw the term come down. Maybe you'd see 3, 4, 5-year deals. But it's a market where people are focused on the spot price of uranium moving. And, as I think about it, and I want to get your view on this, as the spot market will move when the utilities come in size. And it's not going to really move much based on the trading of the brokers buying back and forth. And that's when I look out to 2020 and I say, wow, there's 30 to 35% of these contracted needs by the utilities, or these uranium needs by the utilities, not under contract. And the fuel cycle is a couple of years. It takes 18 to 24 months, but 2 years out. And so they need to come into the market. As you look at the waterfall of expiries in the contract side, and you look at the time compression between now and 2020, they're going to need to start to come into the market. And
yes,
I mean, so talk about that if you can, because I think my view, Daniel, is price trails the fundamentals versus another. I mean,
I don't totally agree with you there. I mean, I think you've got to remember, you're absolutely right. There are two parts of this market, and they do tend to feed off each other. I mean, one of the reasons that there is not much of a term contract out there at the moment has been that guys had inventory. They had access to surplus material because we went into a period of surplus. You saw a steady move into shorter term, mid-term contract and spot contracts going on.
Mm-hmm.
And therefore, the utilities didn't need to secure long-term contract for a while. Right. One, because they already had it, or two, there was so much material around that there wasn't the concern that you weren't going to have the material to meet your fuel cycle schedule. And so I think you still have to be cognizant of what the spot market is doing. And we'll come back to the contract market because I think it gives you a different set of drivers. But I think the one point is going to be here is the utilities will move heavily towards the contract market when they start to see the spot market tightening up in front of them. Mm-hmm. And I think the point that was made by sort of UXC Consult in their recent presentations, as reported in Madrid, is actually when you look at what's available material-wise, I mean, we always know there's been a big inventory. I mean, you and I have discussed, in 1990, it was 2.8 billion. Yeah. So, when people were getting angst about 1.4 billion last year, it was like, guys, it's half what it used to be. I mean, be careful. But what you've seen is guys with those long-term contracts having their positions, they didn't need to be in the spot market, but that spot market has tightened up. I mean, Total trade going on is less than half the total uranium being consumed every year. And 75% of all trades on the spot market are between traders. I mean, they're just moving material amongst themselves, making a margin where they can. But I think that's where things like what's going on at the moment in Cameco, Kazatomprom, Section 232, and some of the supply issues that are about to come into the market are all going to suddenly start to affect more aggressively that spot market trade that's going on there.
Well, that's what I say. I think we actually do agree, not in the sense that the spot will move, but it will move when the utilities start to come into the market, right? And because historically, when you look at it, they're the tail wagging the dog, because the utility buyer, in my experience, and looking at the numbers going back to years and mapping out when inventories are increasing when price is going up. And it comes down to, like, what, for me, I think about what are the power of incentives, right? What's the incentive of a utility buyer? Is it to call the bottom on uranium, or call the top, or call what the price forecast is? No, I don't believe so. I believe the incentive is to secure supply, because if you don't have security of supply, then all the rest doesn't matter. And because it is such a small portion of the overall cost to operate one of these things, uranium, it really doesn't matter. They just don't want to be an outlier.
Well,
right?
but I think what has been, I mean, sort of the sense we've been getting talking to the utilities is everybody understands this market's going to tighten at some point.
Yep.
They themselves are using the spot market as a guide because it's the only place you're actually going to see any kind of movement. That'll be the first signal to them that the market is starting to tighten up. And while we're looking for our offtake for our own projects, you know, the utilities are saying, guys, you know, we're not actually active at the moment, not because we don't know there's a problem coming, but it's right to actually just do nothing until we see momentum. But as soon as we see momentum, we are definitely talking to you about long-term contracts because now we know the market's tightening.
Exactly. And if you think about it, so they're just, to me, when I think about that mentality, they know it's coming, but they're not willing to go in there. So what I said is price moves the decision making, right? They're looking at price versus focusing on the fundamentals. Because if they were really focused on the fundamentals, and they could do fourth grade math, which they can, and they could see the amount of primary mine supply coming out, and then those are the cuts that are announced, right? We're talking the 16 million pounds from MacArthur River. We're talking the 10% cut last year from Kazatomprom. We're talking the agreement on them not to increase production from the Kazakhs for 3 years. We're talking the Kazakhs having the marketing arm, being in the spot market now, being able to buy. So that takes
and DOE secondary sales
and the DOE, the secondary sales, now putting 3 million pounds, 2.5-3 million pounds into the market. So all of that's positive. But then you have to look out, because when we think about uranium mining, you have to think in terms of dog years, and we'll get to
just go back to one of those. I think that's where you've got to be careful about supply cuts, because yes, Cameco's cut mine supply, but they haven't cut uranium supply yet.
Yep,
and that is exactly the point. Is supply the cut from Cameco hasn't happened yet, and I think that is what is going to start to move this market.
Absolutely.
What I've been saying, out talking to investors is, don't expect to happen in the first half, which is clearly is exactly what's happening. Is They will clear down inventory first. Why? Yep. Because they've paid for it. They've got cash sitting there on the balance. They've used up. They need to recover their cash to strengthen their balance sheet. Why would you leave inventory sitting there? And so they're clearing out. This new transaction they've got with Orano, where they've got 5.4 million pounds going to there, it's going to squeeze that inventory even faster. They've made it clear that they only want to have something like 13 to 15 million pounds of inventory left, which is kind of where I thought they would sit.
Yep.
It's mine just in case they have an accident and they need, a problem and they've got to meet their demand. But you can, back to, available 35 million pounds in the market. If Cameco come up at the end of this year and suddenly say, we need 5 million pounds of uranium, and they want to do it in the second half of the year, that's the equivalent of buying 10 over the whole year. And there's a 35 million pound surplus in the market that's what's sloshing around. It's not going to take very long for the market to tighten.
And they've made clear that they need to be in the market for about half, about 18 million pounds. I mean, exactly. So yes, so that's a lot of uranium that has yet to been bought in the spot market. And so that's like in the near term, right? That's the noise. So you could see it developing if you're a buyer in the market, you can see that developing. But to our point, the utilities don't act until they see the price move. And so there's not a lot of forward thinking that's going into that. It's waiting for it to.
It's a double-edged sword. I mean, if let's use Cameco as a good example, though. Your Cameco, you are not going to want to put out a contract at the current price.
Absolutely.
Because what is contract market about? Contract market is about replacing your own resources. Yep. It's about getting paid a uranium price that's big enough to pay for your operating and capital and your exploration costs. That's what your contract market is all about. And so at the moment you've got a public contract market out there, quoted by UXC at 31.
Yeah.
Cameco's, well, there's no way I'm giving it up at that, guys.
No
I've got a book at 44, 45. I want at least 44, 45 before I'm going to have a conversation with you.
Well, exactly. So what I'm saying, So why would you as a buyer, why Cameco has said on the conference call, we don't have the option of being uneconomical. And quite frankly, shareholders would go out of their mind if they're selling the highest grade uranium in the world at these prices. Why would it doesn't make sense to me.
But it's not in a buyer's interest, as you can appreciate, to suddenly say, I'll pay you 50, 100%, 50% more. Which is why we come back to the spot market and Cameco's actions in the spot market. I think the Section 232, once that clears up, whatever way it clears up, it will allow the US utilities. I mean, if you look to the first half of this year and you were reading the weekly reports, you rarely saw a US utility in the market buying.
Absolutely.
In fact, they were just completely absent. I'm now starting to see the word US utility turn up a few times in some of the trade reports. But, that absence has not helped the spot market either. And they are predominantly quite big spot buyers. So I think we are starting to see those bits come through. On the supply side, I think the two we've got to watch out for still is Cominac. And the other one that's been pre-announced is Paladin at Langer Heinrich. I mean,
absolutely.
If they're already talking about it publicly, it probably means within the next 3 months it's gone. Now, the combined two of those is worth, £8 million a year?
Yes, it is. And also, let's look a little further when I said earlier about dog years, right? So these are the mine supply. So that's the mine supply that the market knows is being cut, right? Has talked about. They're focused on what is being cut now, the MacArthur Rivers and the Kazakhs and Langer Heinrich and the others. But in the dog years, as we look out and we start to think about Rangers stockpiles being done in 2020, right? Cominac, which is in your neighborhood in this year, in 2023. And then we look at Rossing, another big mine in Namibia, that's done in 2025. Cigar Lake, the monster up in the Athabasca Basin, owned by Cameco, that's done in 2027, right?
Oh, yeah, so you've got 20% of world production going out in the next 5 to 10 years.
And that's right. So when you think about 5 to 10 years in uranium mining, where you are right now, and you have these 40 some odd projects that are proposed projects that basically they're not being advanced, licensing, permitting, construction, obviously, but because who would do that? Who would spend money to do that when you have this type of pricing? So that can creep up on you. Those closures can creep up on you pretty quickly. And what I was trying to say before about price lagging and the market being unusual is that you don't have a set of uranium buyers that they're taking their cues from the spot market, right? Yep. And rather than anticipating where the spot market's going, it, by all appearances and by past behavior, they wait until all of the events that have occurred occur. So, if you think about stocks, they tend to discount out what's in the future. If you let's anticipate if it's widely followed, they're anticipating what the future will look like. Here, it's even though we know it's coming, until it happens, we're not going to see it. And to me, that just it's very narrow. It's not seeing the forest for the trees, in my opinion. Inventories, secondary supply. We're starting to see a lot of things that are starting to change. I want to switch gears, talk about Goviex. I mentioned to my listeners a lot when I talk about uranium and the markets in general. There's risk on and risk off, right? Risk on is things are going well, people trade up and take more risk. Risk off, people are cautious, they run away. Well, clearly for the last 7 years, the uranium investment sector has been risk off. And then you take it to another level, because not only is it risk off, but then people start to look at emerging markets and they think of Africa, and it's really risk off because they're scared, right? So not only do they not want to own uranium companies, they don't really want to own African uranium companies. But as this starts to change, and we've seen from past history, as the cycles turn, things start to change. So let's talk about Goviex. I mean, you are a Nigerian-based uranium miner. You have 2 licensed projects. Your flagship Madawela project, which is in Niger, and then you have Matanga in Zambia. You've got Zambia. Yeah. What did I say? Zambia.
Zambia. Yeah. It's the one next door. Well, kind of both of them.
Yeah, exactly. I was thinking Namibia when I was saying in Zambia. Now you've got this development pipeline, and then you've got Madawela undergoing project financing. Let's give an overview for listeners of what Goviex is and where you are and what you're doing. Then we'll dig in a little bit further.
Yeah, no, absolutely. I mean, Goviex is an African-focused explorer developer for uranium only. It has 3 projects. Current resource in the ground is 230 million pounds of uranium. Makes about one of the top 4 or 5 uranium companies from a resource-based point of view. 2 of our projects, as you've already said, are fully permitted and ready to go. All of our projects have considerable exploration upside. We basically stopped drilling when we already had defined projects and didn't see the point of wasting shareholders' money just continuing to drill. And we're already working, as you say, of moving the primary project forward. And I think the key, as you were saying earlier about, 10 years of supply coming off and time to react, well, that's what it takes to get a permit in places like Canada, 10 years. So, if the market is changing, a lot of the companies that are out there who most people recognize name-wise won't be able to respond to the market changing. Whereas Goviex is one of those companies that can respond to a changing market.
So let's talk about your flagship. It's Madahuela. It's in Niger. It's about 8 kilometers from Arriva's Cominec. And talk about the project. I want to talk about the mine life. I want to talk about your production costs, your operating costs, and I want to educate listeners difference between your cash cost and what your all-in costs are.
Yep.
And let's dig into Madahuela. Now it's got a 21-year mine life.
Correct.
And I think you're going to need somewhere along the order of $360 million in pre-production capital to get that mine running.
Yep.
Typically, you'll finance one of these things heavily with debt and then the rest with equity. How are you thinking about that?
No, absolutely. It's a 360 build. We're expecting 2/3 of that to be debt financed and 1/3 of it to be equity. And I think that's what, when people talk about risk, most people have this sort of terrorist risk perception or something else. And I'm like, guys, we're building mines. What is your risk? Your risk is finding a decent resource. Well, we have over 120 million pounds. We can just keep drilling all the way down to Arriva because we're in the same ore body as Arriva and expand the resource well over 21. So you've got a resource. All the infrastructure is there. So it's not in a region that has no infrastructure. All of the infrastructure is already there. Permitting risk. Well, we're already permitted. So that was done in 6 months. And the last one is, how do you finance your project? And the project finance market globally is broken. There is no such thing as the old project finance banks around. Most of them shut up shop after 2008 and the losses they made during that period. So I think, that's where we're able to turn around and say, hey, guys, relook at Niger. It's a country that's been mining since 1971. We've already got expressions of interest from banks and ECAs for an export credit-backed debt for about $220 to $240 million, subject to the last conditions, which we're putting together the final feasibility study, getting the offtake contracts into place, and then finishing their due diligence. But, that to me is what risk is in our industry. Can you get a project, find it, develop it, and finance it? And you look around the world, mining companies are generally, unless owned by a major, are having to use equity to finance their projects.
So you have a cash cost of about 25. I'll round up a little bit. I think it's about $25 a pound, and your all-in cost is 36, $37 a pound.
Right.
Tell listeners the difference between cash cost and all-in cost and how you think about this, because oftentimes people I see that are learning the industry talk about cash cost and they ignore the all-in cost. So why don't you clear up what the difference is?
Cash cost is basically what does it cost every day to dig the rock out of the ground, produce the yellow cake, and ship it off to the utility. So all the costs, mining costs, processing costs, transport costs, all the logistics, everything else that you've got to do to run your operation day to day, that is your cash cost. Your all-in cost then has on top of it, which is how much capital do you have to spend? Not just the initial capital, but as you're going on, what have you got to put in as development capital? What costs have you got associated with replacing equipment as life goes along for 21 years? So that is your all-in cost, which means your operating cost plus all of your capital costs for the full life of the project.
And I think oftentimes when I talk to some investors, they ignore the all-in cost. And it's a real cost because if you're not reinvesting in the business, you're not going to be able to keep mining. So,
and that's one of the nice things we actually have at Madahuela is that if you look at a lot of underground mines, they have substantial development costs. You do a lot of work off reef. You're out of the ore body. You're just mining waste all the time just to get back into the ore body and their design. And that is one of the benefits that we have down at Madahuela is because when we start as an open pit for about the first 8 years, and then we go underground. And when we do go underground, though, it's a flat lying room and pillar operation. So you're actually in the ore body. So the majority of our development, as we mine through for 21 years, is actually in the ore body.
Yeah, no.
We treat it as waste from a scheduling point of view, but in reality, in operation, you would actually have that additional uranium.
And so for people who are listening that are not really familiar with economics of mining and how it all works, so here we are, you have a cash cost of $25 a pound, but to keep the mine running and everything else, it's going to cost you about 36. Now you need to go out to investors and get this project financing. Like we talked about the debt, 220 to 240 million. You're going to go to equity investors at the time. So you have project economics and you have the net present value that cash flows over those 21 years. What's the price that you need of uranium to get that mine going?
What we've been looking at and started our conversation with the off-takers is a low to mid 50s price under contract. That's what we're looking for.
Okay. And so when we think about that, and I just want to frame this put it in context for investors. So here we are with a $20 spot price. And we talked about the production cuts that you see that have occurred, and then the mines that are going out of production, which is a meaningful portion of supply coming forward. And because of this price of uranium right now, new mine development is not occurring. It's not occurring as we go because it doesn't make sense to spend millions of dollars to further a program, a mine, whether it's licensing, permitting, or anything else at these prices. So when we talk about a supply squeeze that could be coming, and we talk about dog years of uranium, meaning if the biggest mine in the world or the second biggest, Cigar Lakes, in 10 years is going offline, plans for these other mines need to be in place right now and going, and you need to start seeing construction. So Goviex has your permits, you have your licenses, and once that go decision comes, which is why one makes the argument, it's kind of how I view it, is people think that the bulls are crazy when they say, well, if it's 20 now and you need $50, $55, ain't going to happen. Well, then you're not going to get uranium. The utilities are not going to get the uranium they need. And the utilities, to the point we had earlier, the inventories, they've always been this high at every cycle turn, and they've been higher. So walk us through the anatomy of the go decision. You make the go decision, and then you do this. How long does it take you to construct your mine?
A couple of things. One of the things we're doing as well is while we're in these quiet times, we're continuing to optimize what we can. So we've looked at membrane separation, or nanofiltration as it's called, as well. And we've shown that we can actually recycle a lot of our chemicals. Chemicals are a big component of mining. So there are ways that you can substantially look at reducing your costs. So we think we could probably bring our costs down by about another 10%, both on an OPEX and CAPEX, probably startup CAPEX, probably about another 6%. So, these are the kind of things you can do as well while times are a little quieter. But the anatomy is quite simple for us, is that once we see traction on the price, I don't need it to be up at 50 to give the go call. The starting point is effectively, once I see good momentum on the price, we're moving up into the low to mid 20s. It's clearly going somewhere. It's not going to just do a jump, right. And that will show very much by how it's going up. If it's just spike suddenly to 25 next week, we'll probably look back at it and go, okay, is this the one, or we're not sure. But if we see it steady, 22, 23, it just keeps moving up month on month during this half into next half, we'll make that call to say, right, let's get going on the final feasibility study. That final feasibility study we've been deferring simply because, for me, it's not just a 43101 document. It's actually my mine planning document. It's the document we will build from, and it's not just for a filing document. So we've been holding off on it because they're not cheap. You got to do a lot of engineering work for that final run-in, because it includes all of your detailed logistics, your detailed planning, your wiring diagrams, and everything else that you want. So just get on and do it. So that'll be the first call. And then at the same time, we'll put a lot more pressure on the banks to get all of our signatures off with them. We'll obviously at that point be going back to the off-takers and saying, guys, look, the momentum's there. We're now getting going. Get on with your due diligence that you want to do. We want to have this whole thing penciled up, boxed off, probably within a year, assuming this momentum continues. At some point during that year as well, we will then start to look for credible equity. But that credible equity will be a lot easier conversation because we will be able to show the equity side of the investment, whether that be a single at the mine investor or somebody coming in higher up or more general equity. Here's the offtake. Here's the signs where it's going to be. Here's who we're talking to. This is the work we've done. Here's where the debt guys are going. You're going to be the last piece of the puzzle, but you will come in at the same time that the other three pieces come in. That will then close everything off in one go. We'll say, right, feasibility study's done, debt's ready, offtake's in place, equity's in place. Right, go trigger to build. At the moment, we're assuming 2 years to build, but what we're also doing as part of the feasibility is looking at continually modularizing our mine. And to me, in the old days, modular just meant one or two or three of the same thing. So instead of doing one big thing, you'd have three or four of them, so you reduce your risk. It's changed a lot in sense. What you can do now is buy pre-manufactured, fairly large parts of your process plant in kit form and actually within a container. So in our case, you can buy the crushers, you can buy the solvent extraction plant, you can buy the packaging plant. All of these parts can actually be the radiometric sorter. Even the tanks can be bought pre-manufactured, delivered to site, and installed in a matter of hours, rather than the old days where you would build everything from scratch on site. And that obviously removes a lot of your risk as well, because now you're placing a lot of your construction risk offshore. You're reducing the number of expatriates or skilled personnel that you may have to bring in because you can't find them in country. And it means that the local people as well see that they're effectively the ones finally building that mine and putting it together. So it has a lot of positives in the way you can do that.
So I want to put Matanuela in context. So when it's up and running and everything's going as you planned, you'll be producing about 2.6 million pounds a year. And I want to frame that and help contextualize for listeners who are not familiar with the nuclear and power and uranium space. If we think about the biggest mine in the world at McArthur River, we're probably talking the ability to produce 16 million pounds a year. And as we start to go down and we look at, we were mentioning earlier, we were talking about Langer Heinrich and we were talking about Rossing. There you're talking about 4 million poundish a year, 3 to 4 million. If they were running at full capacity, they're producing less. But that's about what it is. So at 2.6 million, it's meaningful. But for those who worry, oh, well, there you go, in 3 years, more supplies coming online, right? And one of the things I observe in this industry, which is very opaque and not a lot of research out there on it, is people take a data point and run with it. So a new mine could come online at this price. Well, where does it fit in the grand scheme of things? There's 200 million pounds plus that are needed when you consider all the new start of reactors that are coming online. So I want to help contextualize for investors. We're talking 2.69 million pounds when you've got a lot of supply coming offline. So while it's meaningful cash flows and everything for Goviex, in the grand scheme of things, it doesn't really move the needle from a supply standpoint. It helps, but it's not something that this mine comes online and it hurts the supply-demand dynamics that's going on. And so to get there, you have about 112, Matanuela has about 112 million pounds of measured and indicated resource, about 28 million pounds of inferred. And then your next biggest project, the Mutanga project in Zambia, that is about 15 million pounds or so of measured and indicated and about 45 million pounds of inferred. Now that has an 11-year mine life with a little bit higher cost. Could you talk about Mutanga and your timeline and where you are there?
Yeah, Mutanga is quite an interesting project because actually two previous projects put together. So you're right, it's about 15 million pounds measured and indicated. It's about 45 million pounds of inferred. All that inferred is almost in one deposit. It's a very simple open pit heap leach operation. Mm-hmm. Its cash cost is about 31, and its all-in cost is about 37. So whereas you look at Matanuela, where you've got about $11 or $12 difference between cash and all in, it's a lot tighter at Mutanga. Why? Because you don't have a lot of capital. It's a very simple project. It's an open pit mine, just straight onto a heap leach. It's lower grade than Matanga, but it consumes a lot less sulfuric acid. And sulfuric acid is generally one of the biggest consumables we have in our industry.
How much is that? How much sulfuric acid as a percentage of your cost?
At Madahuela, it's about 10%. At Matanga, we consume a tenth, so it's almost insignificant. And we happen to be in Zambia, which produces sulfuric acid as well locally because of the copper mines. So it's going to make it a lot cheaper accessing it there. Now, that project is, again, permitted. It's ready to go and would take about the same time frame to get up and going. I mean, really on that one of the benefits we had is having two companies do feasibility studies, pre-feasibility studies. And they came up with very similar results for two different projects, which makes it, gives us a lot of strength of confidence that combining it together, the numbers are right. Some infill drilling on the one big deposit at Dibwe East is all that's required to really firm that project up, recost it, and it can be going. And one of the points you were making earlier just about the size, I mean, yes, these projects, when you put them in scale, they're not a Cigar Lake or a MacArthur River, but what they are is they're over £2.5 million per annum, which is what the big off-takers want. Yep. So it's meaningful enough for the big off-takers to want it. They're longer life mines. And this is one of the problems you got with some of the smaller ISRs in the US and whatever. They're small projects. They're not got the life and they don't have the size, whereas these projects allow these big off-takers to diversify their supply risk. They're able to get from a number of players. And it was interesting. I saw an analysis talking about Section 232, and I think it was Duke Energy said that, they do not take more than 22% of their feed from any one off-taker.
No, that's it.
Sure, they spread their risk.
And just for listeners, Section 232 the Commerce Department. The Energy Fuels and UR Energy, two U.S. miners, petitioned the Commerce Department under Section 232, they're asking the U.S. Department of Commerce to force the U.S. utilities to buy 25% of their uranium from U.S. miners, because right now it's a tiny portion that they buy, and the U.S. imports almost all of its uranium from outside sources. So that's when Daniel's mentioning 232. That's what he's referring to. Daniel, real quick, and before we end, we have to talk about this because investors hear Africa, they get nervous, right? Especially in a risk-off period, and then they hear West Africa, and if people are paying attention to current events, they might get a little nervous because Mali obviously is a very tough neighborhood, and Niger is also in West Africa, and people worry, and they say, and I get this question a lot about Goviex. Well, what about Boko Haram and Al Qaeda? They're out there, and talk about Niger's role in the global uranium mining space and how long they've been doing it, and the importance that Niger plays for French uranium, for French nuclear power. If you can touch on that. Yeah,
I mean, at the moment, Niger produces about 8% of the world's uranium. It's been doing it since 1971. It's about 34% of Areva's uranium comes from Niger. And I think one of the points that, investors don't understand is that within there is, a wider security issue in North Africa and West Africa. But the one thing that you will find is Niger, Cameroon, Chad have got this very much centralized safe core, which is being utilized by the EU, by the US, by the Canadians as a very strong base in the middle of West Africa because they are such stable countries. I mean, Niger has got one of the longest running democratic governments around. It's a very secular country. It is Muslim, but it's very secular. It is very robust in protecting its borders. When Nigeria had its Boko Haram problems, it was Chad, Cameroon, and Niger that went in and basically helped resolve that problem. And I think the other thing we all have to realize as well is these are big countries. I mean, they are enormous in size. And what you often see when you look at the sort of map, because, 90% of the country's got nothing in it, security agencies just tend to cover the whole country in one color, because otherwise how trying to pinpoint the little bits and pieces
Right.
would be nigh on impossible. But when you've got a country twice the size of Texas, you can be at one end of it, and something could go at the other end, and it's so far from you that it's insignificant. It's a bit like the incident recently in Toronto, and you're in Vancouver.
Right.
You're not going to worry about it because, and I think also Goviex has made very clear, we understand the risks are there. But the other thing that we have done as a company is made sure that we localize our operations as much as we physically can. And in fact, in all three countries we operate, we only have local employees operating them. And we're quite comfortable with that because the skills that are available are there anyway. I mean, with a country like Niger, which has been mining uranium since 1971, using local Nigerian labor to do all of it, why do I need to bring anybody from outside to show me how to mine uranium in Niger?
Right.
They're quite capable of doing it themselves. And that changes the risk dynamic a lot.
Talk about shareholder base.
Mm.
Your largest shareholders, and Govin Friedland, the Friedland name is well known in the mining space,
Yep.
And who he is and who some of the large shareholders are.
Yeah, well, if we go down in order of them, Denison Mines is the largest shareholder. They came in as part of a transaction, but they've obviously got Lucas Lundin as a backer. Lucas actually happened to be the first private shareholder for Govin when he started the company up as well. You then have Govin.
And Govin being the son of legendary miner Robert Friedland.
Well, that's right. I mean, and that is why he saw the opportunity. He was living and working in China at the time, running around the streets, coughing and spluttering, and realized that, pollution was going to be a major issue, and he wanted to be part of the resolution to it. And so all of those relationships, that ability to understand the market and the business model, we benefit from being part of that wider Ivanhoe group as well. And Govin's relationships with his father and his experience of working at Ivanhoe. And then below that, we currently have Toshiba, but as everybody will see, we paid the money for our debt.
Talk about that transaction just quickly, how you paid it.
We basically came to a settlement with Toshiba that we would pay them half of the current debt position. It's a uranium loan. They know that because of what's gone on in Westinghouse, etc., they decided to clear up their balance sheet. And we agreed with them that we would settle the loan for a fixed amount. And it is a leveraged uranium loan. So as the uranium price goes up, and it was payable in 2020, the size of the debt from a value point of view would go up, as well as the interest in uranium that would be going. So it was a useful way for both Toshiba and Goviex to finalize that and for us to clean up our position going forward. They have been on holiday for a week, so we're hoping to sort that out in the next week or so, final documents, etc. Okay,
so we're kind of out of time right now, but I enjoyed talking. I always love talking macro uranium stuff with you, and you always do a lot of your own research, which I like. And you've got a lot going on now. You just need the price to move a little bit.
A little bit of price movement would make our lives a lot more interesting. And I certainly think we've kind of gone through the hard times. And I certainly think, reading a lot of the trade magazines as well, I mean, even UXC, who always tend to be a little more bearish than most, are starting to show signs of optimism out there. And I take that as a real positive. I think, once you start seeing those guys talking some upside and some positive market and talking about how the market's tightening, it's starting to feel like, yes, we're getting to the point where this thing's ready to turn. I don't think it's going to rush off this year, but what I want to see is a good, steady price trajectory over 2018 that gives us all the confidence that this is it. We can now start planning for the future.
Great. As always, Daniel, it's great talking, and
thanks, Mike.
We'll be in touch soon.
All right. Thank you.
Okay,
Take care.
Thanks. My next guest is somebody who opines on deeply cyclical industries and commodities. He's an economist and he writes research. And I first became familiar with his work on Twitter. And again, if you're not on Twitter, or if you just, I suggest it. I like it. I'm a big fan. And I've come across so many bright people, and my guest being one of them. And We're going to talk commodities, and we're going to talk. He's going to give you an industry that he really likes, and he's going to talk about what he looks for when he's looking at either longs or shorts in the industry. So let me bring on Peter Sainsbury. On Twitter, he's Peter Sainsbury7, and he writes a newsletter I'm going to let him tell you about. So Peter Sainsbury, welcome to the podcast.
Hi, Mike. Yeah, thanks for inviting me on.
Oh, my pleasure. I first became acquainted with your work about a year ago on Twitter, which has just a fascinating platform. And I had never been really a Twitter user. I think I signed up in 2009, but I never used it until about a year ago. But I saw, I like commodity space, and I found you. I don't know how that occurred. But as I kept seeing you tweet, I kept saying, God, I think like this guy. We think alike, and I really liked your work. So why don't you share with the audience who you are, give your background, and what you do, and how you think about the commodity world?
My name's Peter Sainsbury, and I'm an economist by trade, but I don't want people to hold that against.
Yeah,
I
was going to say.
But I kind of like to think of myself as kind of on the edge of the subject, really, trying to take inspiration from other fields as well as economics, because I think that gives you a kind of a rounded picture of what the real world is like, rather than just the theories that economists come up with. And just a bit about my background, I've been the web site that I write for, Materials Risk. I've been doing that since about 2011. Kind of really to sort of follow my passion about writing about commodities. And since 2015, I've written and published 2 books on commodities. So the first one of those is Commodities: 50 Things You Really Need to Know. Mm-hmm. And last couple of years, there's a book called Crude Forecasts: Predictions, Pundits, and Profits in the Commodities Casino. So it's a real passionate area of mine.
It's great. What intrigues me about the commodity sector, and when I first started out investing, I was not really focused on that. I was new in the industry, and we did a lot of short selling, but in more secular type businesses. But as I became more experienced in my investing career, what struck me about investing in the equities of the underlying equities in the commodity space was the cycles and the peaks and troughs. And the more I started to study, the more I realized it was really an exercise in human behavior and watching how people don't really recall the past, and they get caught up in the emotion of the trend. And I soon started to realize that, wow, this is a way to, and I have a contrarian bent to begin with, but it was really a way to express my contrarian view by entering that arena of human emotion. So what is it about the commodity markets that fascinate you?
Well, I think, like you said, there's they're repeatable cycles. It's either it could be an annual cycle in the case of a particular agricultural commodity, or much longer term cycles driven by the business cycle, structural factors like the number of years to invest in a particular mine, and then kind of really sort of much longer term cycles over generations that have an impact on the supply and the demand for commodities. So I think it's kind of what excites me so much about commodities is that it brings together all those different factors that you contribute to cycles, everything from growth in economies to demographic factors, how technology changes over time, and I think the message that I've been trying to get across in what I write and on Twitter and elsewhere is that these cycles are repeat themselves, and at any one time, if you can understand where you are on that cycle, then you've got a good chance of understanding where the future could hold.
I always love when I'm looking at a commodity-driven industry when the argument is different. It's different this time, and right, and it tends to happen near troughs and near peaks. Why things are going to change? It's going to be a different cycle, and I get really excited when I see that. Mm-hmm. So, when you're analyzing a commodity market, what are some of the things that you look for? What's your playbook, if you will?
Yeah, I think it's kind of really to understand what really excites me is to find markets that are at extremely extreme pessimism. That everyone thinks that no one is ever going to buy that particular commodity again. The world's awash in that commodity, and no one really needs it. Investors have thrown in the towel. Everyone's sick of it, and that gets interesting because then you can see that asset prices are way below even the market value. If they were sold off, and then what I'm trying to look for is things like how are people behaving in that market? Is there a kind of a security of supply issue that maybe not present at the moment, but could develop in the coming years? So it's really kind of trying to understand the motivations of the people within that market and how it could develop over time.
No, it's very similar to how I think about it and look about it. And so you're doing your analysis, you're looking at supply, demand, and inventories and all that other stuff. What role does probability weighting the analysis play for you?
Yeah, no, I think that's a really good question because I think it's a difficult thing to visualize when you're looking at prices, looking at markets. But I think, as in anything in life, you kind of need to think about what are the chances of that thing happening, or whether price is going up or price is going down. I think the trick for investors or physical participants in the market is to understand cycles. So where we are, what's happened in the past, understand market positioning. So coming back to things like I was talking about before, in terms of is there going to be a sudden rush of people buying in a particular market? People fearful of security of supply issues, and then kind of thinking about events that can buffet any particular market, geopolitical, central bank driven factors. There's always a history that investors can look at, and you study that history, you can begin to see the patterns that evolve, and then work out a kind of a probability of how the future could develop, based on where we are now.
It's very similar to how I look at it. I use uranium for an example. When I'm looking at a commodity or a market, and we'll use uranium, I'm looking at if I'm wrong, what's my downside? And you look back to the past, right? And you look at what the supply dynamics were at the last trough. You look at what the demand drivers were at the last trough. And I say, okay, if my thesis is wrong, and we all know we can be incorrect in our thesis, we could be way too early, whatever it may be. But what's the probability I'm wrong? And then how much downside do I have on that? And then what's my upside? And that's where I kind of, look at, you try and find where the risk is so greater, the risk is so much less than the reward. The reward's so much higher. And I find that you can really apply that in deeply cyclical commodity industries. One of the things that you do is you do a lot of writing. And throughout my career as a hedge fund person for 20 plus years, my writing really wasn't writing. It was spreadsheets. And it was handwritten notes, right, that were all over the place. But it was all in my head. And you have to be really careful as an investor to not have thesis creep, because you have a thesis, you have conviction on the thesis, but things change. Yeah. And one of the things I've had since I started writing the newsletter and the last while, and I'm more organized in my writing thoughts, it memorializes your thoughts, and it helps prevent thesis creep. How does that factor in for you?
Yeah, no, I think it's a great sort of habit to have. I think, to organize your thoughts, and you can kind of go back to it in months, years in the future to kind of understand, what you were thinking at that time. How do events today compare with where you were in the past?
Yeah.
I've been using, I kind of call it a decision journal. So it's kind of, as well as my kind of sort of more public writing. Whenever I'm thinking about a investment decision or something business related, I try and kind of describe where we are now, what the situation is, some of the factors that I'm thinking about, either bullish or bearish, and really try and, when I'm at my most rational, try and decide, at what point will I think, that was a bad decision, I should get out of this. And I really think you need to do that before you actually press buy on an investment or make a decision, because then you're at your most rational. Whereas as soon as you've entered something and you've made a decision, emotions start to play a bigger role.
One of the things I see on Twitter, I see it a lot, is people will put out, they'll tweet something that say, so-and-so investment bank raised their rating and price target, or lowered their rating and price target. I personally, in my career, and I learned early on that that's worth about the paper it's written on. And I don't think the analysts are not bright people. I think they're very bright. But one of the things, and you and I have only spoke, is it's so important to understand the power of incentives. And whether it's an analyst writing a research report, or whether it's speaking with a buyer in a given commodity, how are people incented? What motivates them? How do you think about that when you're incorporating that into your analysis?
Yeah, I think that's a great point, really. I think both, just thinking about Twitter, you see so many people saying, so-and-so said this, this investment bank is forecasting this to prices. I think the first point to make is, it's very easy to see that in isolation and kind of think, they must know what they're doing. Let's just follow their lead. But the reality is, like you said, they're smart people, but forecasts tend to be very badly wrong, even in more established markets like the oil industry. But then, I get on just in terms of incentives. If you think about just purely like an investment bank, you think about why are they putting this forecast out into the public domain? It's to publicize their services. They're selling consultancy services and investment banking services to their clients. So you need to be aware of why they're doing this research and who are they actually trying to benefit. And then I think it's thinking of things like sometimes you see a range of different forecasts on a particular commodity, and there's a consensus, and you see someone jump out an extreme forecast. You have to ask yourself, why are they putting out that extreme forecast? In the past, it's tended to be, they just want publicity.
Yep.
And they get some news coverage. Everyone's talking about them. But then 6 months, a couple of years later, when that forecast is may have happened, but it probably hasn't happened. And people tend to forget about them, but then they still get invited onto financial TV to spread their next forecast. So incentives are very powerful, and everyone needs to really take those into account.
When I'm looking at different commodity markets, what I find interesting is it's almost like a pyramid in terms of information flow and pricing, meaning I find that the more opaque and complicated a market, the less efficient it tends to be. and I use uranium as an example, where it's the most complex market I've ever analyzed, and also the most opaque market I've ever analyzed. And if you take the time and the effort and to really drill down into the fundamentals, what you realize is that the narrative is quite disconnected from what's happening underneath the surface. How do you think about market liquidity and information that's out there when you're looking at all of these different commodity cycles? And I'll make it up, but frozen orange juice or cocoa or whatever, and things that are less liquid. How do you think about that?
Well, I think it's, narratives, can last a long time. They can persist for a long time. When, for, say, oil, it's, sort of lower for longer until relatively recently.
Right.
Growth in electric vehicles, is another. But they, narratives are, very powerful. They connect, the forecaster or someone who's telling the story with whatever sort of deeply felt value or need we feel as investors or buyers and sellers in a particular market. So I think that the danger is that these narratives are held perhaps too tightly, and then you ignore the evidence that perhaps runs contrary to that narrative, and that works both on the when prices are high and prices are low as well. And you really need to kind of have a strong stomach, I think, to really kind of step away from the herd and just take a step back and really think, what is actually happening here? Let's step away from that narrative and not become beholden to it.
Well, that segues right into my next question, which is the thing that for me it's always difficult to balance is being a contrarian and knowing when to ride the narrative or when to ignore the narrative, right? And I find where it really becomes difficult is when when you've been, let's say, an industry is at its trough, and you have a variant view, and if it turns out you're right, the hard part is when do you sell, because the momentum and the tidal wave of people shifting from the bear camp to the bull camp starts to really pick up speed. It's interesting because I often read things in the newspaper that I myself, and it's big headline on something, I thought, my goodness, who didn't know this? It was out there 6 months ago or a year ago. All you had to do was do a little bit of work. But it's just really coming into the fore, and that's just starting to change the narrative. So it's you're then on the upside, you have to think about you're part of the ever increasing amount of momentum towards the changing narrative. So it is for me, it's always a balancing act and trying to figure that out. How do you think about that?
Yeah, and I think I have to say that's probably been my biggest flaw in the past is like you say that having a contrarian view, I find comfort in that having that kind of view and not being feeling of being swept up in the market. So in the past I've been guilty of selling out of a position much too early than I perhaps needed to. So I think it's a recognition that you're trying to ride that you're trying to ride that narrative, ride that trend.
Yeah.
And spot the signs near the top, or if you're short selling near the bottom, and step off before that narrative is discredited. But it's very tricky.
It is. It's tough, right? What I've tried to get better at over the years is, when you're a contrarian and you're going to have a variant view, or your work leads you to that, not have a variant view for the sake of having one, but your analysis and research leads you to having that variant perception. And so when you're doing that, you're in the weeds, you're digging down, right? And then all of a sudden, what I've done over the years, and I'm still not masterful at it at all, but I try and do is, as it's starting to turn, that's when I try and take myself from the weeds, and it's as though I'm trying to float up to the top of the room and looking down and saying, okay, now what are all the people saying? I'm looking at it like in my mind's eye, saying, where are we, and where on the scale of enthusiasm are we? And it's hard, but
and I think that's where the things like a decision journal becomes so important. You've documented in advance kind of what you're thinking now, and when you might step off that. Right. Whether it's, on the upside or the downside.
Absolutely. So if we think about a market right now that you're looking at that you think is mispriced, where the narrative is incorrect, you want to share one?
Yeah, I mean, I'm quite, I kind of perhaps have some comfort in looking at markets that, have, sort of deep cyclical markets that, evolve over a long time. And one I'm kind of looking at the moment is just the potash market. And, it's got similarities to some, many other sort of longer term markets as well.
And for those who don't, I don't mean to interrupt, but for those who don't know, potash being a fertilizer and the most expensive of the fertilizers. So,
indeed. So, supply is concentrated in, three countries, Canada, Belarus and Russia. They cover more than 60% of the market. But prices, they peaked around about $900 a ton back in 0809. Currently around about a third of that level. But they're starting to pick up and starting to show signs of bottoming out. And there was recently a mine collapse in Belarus back in March. And that kind of put a bit of a shock into the market. There's a sort of recognition that all the other mines are running at full tilt, and the growth in demand for higher protein agricultural products in Asia is still that is still a theme that's running. So these countries are going to have to buy back into the market to secure that fertilizer. So I think it's an interesting market that's starting to find a bottom. And while I'm not necessarily suggesting prices could go back up to those levels of 0809, there's frequent mine collapses and floods that really send a rocket through the potash market every so often. So I think that's when you're thinking about in terms of asymmetric bets that we've talked about in the past, I think this is potentially one that looks quite promising.
I tend to find in commodity markets that are highly concentrated in supply, I've come to expect the unexpected. And whether it's a flood or whether it's a behavior that can try and control pricing, it's something to always be on the lookout. One of the things that I have evolved into over the years, when I was a younger guy, it was sports page first. I'm still reading the sports page, but as you get into your early career, it's reading the business papers and the FT and the journal and so forth. But as I've grown as an investor and a person, my travels from an investing career have taken me all over the world, and what's also changed a lot, and I think has helped me as an investor, is I've become much more well-read about topics way off of investing. Whereas in the first few years of my career, if I was on a plane somewhere, I was reading a financial analyst book or something like that. Whereas now I'm reading about current events and history and everything else under the sun away from investing. But I think that opens me up to be a better investor. How do you incorporate, what do you read? How do you think about it? How do you incorporate stuff outside of what we look at every day?
Yeah, no, I think that's a great question. And I think I've been guilty in the past of, just reading lots of economics type books that kind of, in the past have kind of reiterated, perhaps what I already knew or, what I was interested in and liked. But, more recently I've tried to read, much more widely, trying to gain a much better understanding of maths and probability and, technological developments, how things have evolved over time and where the future could take us. From a resource investing point of view, how geology, how it works, why that's so relevant when you're thinking about individual companies. So I think perhaps one other thing to add to that is looking at fiction as well, reading a lot more fiction. Mm-hmm. It's very easy to become stuck in a mindset of this, the world we are in at the moment is how it is. Whereas I think looking at more sort of sci-fi and fiction like that can really open your eyes, and you can imagine a different future, and that can open your eyes up to opportunities which perhaps you might have been close to before. I think it's as wide as possible.
Yep. What do you? What's your biggest Achilles heel? So if, for listeners, what is it that you would say? When I'm wrong, I tend to be wrong on this way. Or what is it that that deep in your mind that you need to be aware of when you're investing? Because we all have them. I have plenty. Mm-hmm. What is it that you think about? What's a lesson learned that you think listeners should know?
What a question. I think it's just to kind of know the limits of your knowledge. It's very easy to think about enough about a different market or a different sector, and you think you've understood it. You think you know what's going on, but you just don't. And so I think it's really to kind of, mistakes I've made in the past when I haven't really understood something. I think being a generalist is a great thing because it opens your mind to different opportunities in different markets. Mm-hmm. But I think that needs to be balanced against understanding, having a deep understanding of a particular market as well. Otherwise, you can fall foul of making mistakes.
So, how do people find you? I mean, first about your books. How do they buy your books? And how do they find your daily writings?
Well, I guess the first place, my website is Materials Risk. So that's materials-risk.com. People can find me on Twitter at Peter Sainsbury 79. And both my books are available on Amazon, either as a audiobook, a physical book, or a Kindle book as well.
What I would like to do is, because we look at a lot of the same markets, is have you back regularly to where we could talk through markets that are at peaks and markets that are at troughs. And maybe the next time you're on, which will be in the near future, we could kind of lay out and devote the podcast to how we're thinking about a particular market, kind of the anatomy of analysis. Are you open for that?
Yeah, absolutely. I think it sounds really, really good idea.
Okay, great. Okay, so for everyone listening, Peter's committed to that. He's going to.
No getting
out of it now. But I enjoyed the conversation a lot. My kids look at me and roll my eyes when I say something most of the time. So I think that's it knocks your confidence down once in a while. But so it's nice when I'm reading and listening, and I'm someone that thinks alike. And so I like to. I enjoy reading your stuff on Twitter and reading your website. So I appreciate you. I really appreciate you coming on, and we're going to have you on pretty soon again.
Thanks, mate. Really good for that. Cheers. Bye-bye.
Thanks, Peter. Well, I hope you enjoyed our deep dive into the world of deeply cyclical investing, both uranium and other commodities. And it's kind of where I spend a lot of my time. And like I said earlier, it's a place where I think you can really find some asymmetry in the market. So I hope you enjoyed it. I will be back same time next week. In the interim, have a great week and stay cautious.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.